1 month into the new financial year, and our stock market is off to a flying start, while other markets are more cautious. A quick update on the month that was, and the market outlook ahead for August, here and around the globe. After an 8% increase last financial year excluding dividends, our stock market appears to be coping well with the challenges from overseas on trade tensions and other squabbles, with about a 1.5% gain in July, larger than most around the world. Other markets were less impressive, with commodities mainly losing ground in July and some weakness in bond markets. But with doubts growing about China coping with the US import tariffs, the Chinese fiscal package in response was well received by the markets, with its tax cuts for business, extra liquidity for Chinese banks, and the weaker currency. As the chart shows, the People's Bank of China have encouraged a weaker Chinese renminbi against the US dollar, pushing the dollar up to over 6.8 yuan, more than 10% from where it was back in March, before the trade tensions started. This is one of the reasons the Aussie dollar remains under pressure, as its value is increasingly correlated to China. So with the Chinese yuan likely to stay weak, there is still downside risk for our Aussie dollar, especially with the US growth rate running at over 4% and another US rate rise expected in early September. Trade war risks still dominate the offshore outlook, but there is some good news there, with not only the Chinese fiscal package, but also progress in talks between the US and Europe, with Trump and the EU's Juncker reaching a truce on car tariffs. It's still too soon to suggest these risks have passed, but it will be a good thing to ring-fence the tariffs to as small a group as possible. For Australia, the international trade risks need to be looked through the prism of their impact on China and our major trading partners. Locally, our risks are primarily with the housing market, which does continue to soften. However, as the chart shows, while we're experiencing another pullback like in 2009 and 2012, historically, these haven't lasted for more than a year or two. This one may be a bit longer given high household debt levels, but with the jobs market remaining resilient, the falls will just come down to meet demand levels. These dynamics, however, are exactly why the RBA rate rises that we had expected later this year are now more likely in 2019, as well as with the risks from trade markets that have emerged. Funding markets are also tightening independently from our Reserve Bank, the chart showing the recent squeeze initially from the US. So, with their rates still heading higher and money markets remaining tight, plus a low inflation read here last week, the RBA will keep interest rates at these record lows and see how the markets fare in the months ahead. And finally, population growth, running at 1.5% annually, so one of the highest in the G20, has been one of our key drivers of economic growth for some time now, and Australia's population is set to tick past 25 million next week. And that's the market update from Bendigo Bank.